starting. All attendees are in listen-only mode.
Welcome, everybody, to the next installment of the Teach in Tuesday webinar series. Although we're doing this on Wednesday this week, as we did last week and we'll do next week, this is typically a series OurCrowd conducts twice a month on 2 different Tuesdays. We tackle all different types of complicated and less complicated information about the investment process. I'll be one of your hosts, Zack Miller. Joining me, who I'll introduce in just a second, is David Stark on our investment team. But tonight we're talking about term sheets, and we hope that you'll walk away from this presentation with a lot more information about how to read a term sheet, particularly the type that we produce at OurCrowd every day. This is the second part in the series. We will send out an email afterwards. If you didn't get a chance to attend or review the original session, we will address that. We'll send that to you tomorrow. So let's just hop in. Just so you know who you're talking to, I'm the older looking guy on the right-hand side. I'm a partner here at OurCrowd. Joining me is David Stark, who's a partner on our investment team. You see our Twitter addresses there. Reach out to us. We're happy to answer more information if you have it later on. Just a quick word before we jump into the meat of the conversation. OurCrowd is a leading equity crowdfunding platform. We have over 8,000 investors from around the world. We've literally tallying over 100 countries in terms of participation. We've invested in 70 different companies, primarily in Israel, but expanding our purview internationally. Part of the process is, as an investor, you can log in. You accredit on our website, and you have the ability and the discretion to invest in an individual deal or build a portfolio on our platform. One of the documents you'll get is a term sheet, and it's for this reason that we are launching into this type of conversation tonight. We've had questions over time. How does an angel read a term sheet? How do professionals like OurCrowd craft term sheets? Anyway, that's what you should walk away with tonight. David?
Thanks, Zach. So before we jump into today's session, I just want to do a quick review to remind everyone what we discussed last time. So in last week's session, we discussed valuation, liquidation preferences, and employee stock option pools. The key takeaway of that session was that you really need to understand the interconnectedness of various terms and to see the whole picture of the term sheet in order to really understand the different elements of the deal. After last week's session, we actually got a number of really good questions that were sent to us over email. So I just wanted to take a quick minute to address some of those questions. The first question was, what happens to liquidation preferences in the event of an IPO? It's a great question, and we spent a lot of time talking about the benefits of liquidation preferences. But it should be noted that preferred shares automatically convert to common shares in a qualified IPO. So all of that discussion really doesn't relate to IPO scenarios. It relates to any sort of liquidation event, which is defined in the term sheet as an M&A or a liquidation of the assets. The second question was related to the investment amount, and that question was to explain how warrants work. So warrants are the rights to invest a certain amount of money at a certain price for a period of a certain number of months, okay? So all three of those aspects of the warrant deal are predefined. Often, instead of it being X amount, which is a dollar amount, it's actually phrased as a percentage of your upfront investment. So you'll have something like 50% warrant coverage or 15% warrant coverage, which means if you take your original investment amount, that percentage is how much you have that you can invest at a later point in time at a predetermined price. So a real life example, we have one company currently funding on OurCrowd, and in that deal, we negotiated 15% warrant coverage at the current price, and those warrants are good for 2 years. So why is that so valuable? And in particular, I'll focus on this deal. So in this deal, we're getting in at what I think is a very attractive early stage valuation of a $3 million pre-money valuation. And what they're saying is that for every dollar that you invest in the company, you could then put in 15 cents, okay, for another 2 years at today's price. So the value of the company could actually appreciate greatly over that time, and you're able to then buy in when your options are in the money, as you might think about it. So what are we going to discuss today? Today's agenda includes preemptives, anti-dilution provisions, board of directors, information rights, veto rights, right of first refusal, drag-along rights, and registration rights. We have a lot to cover. Lest you think that we covered all of the exciting, most important topics last week, without ruining the surprise, I think that on today's session, we're going to be talking about what's been dubbed as the single most important term in the term sheet apart from price, So let's jump right in.
Right. That's the Easter egg along the way.
So preemptive rights, also known as pro rata rights. Pro rata right is the right to invest in later rounds in order to maintain your ownership percentage in a company. So here's the answer to kind of the surprise at the beginning. Fred Wilson, partner at Union Square Ventures, says, I think pro rata is the single most important term anyone can negotiate for in a venture capital investment. Why is that the case? What's so important about pro rata rates? Because returns in early stage investing, they really are driven by a small percentage of your portfolio. As we all know, early stage investing is a high risk asset class, and the concept is that a certain percentage of your investments will go to zero, but the ones that succeed are going to be really big winners that are able to generate all of the returns, so that in the aggregate, you actually make a good return on your money. So because it happens so that the small percentage of the investments are what drive the returns, you really want to own as much as possible in those outlier companies. So let's illustrate with an example. How does one calculate what their pro rata investment amount should be in a follow-on financing after they've made their initial investment? So the formula is you take your ownership percentage in the company times the new investment amount. The new investment amount meaning what is the total size of the new funding round, and that equals your pro rata right. So let's take an example. Let's assume that in a Series A financing, you invest $100,000 at a $10 million post-money valuation. So as we learned last week, in order to figure out how much you own of the company, you would take 100K divided by 10 million, and you would calculate that you own 1% of the overall company. Now let's say Series B comes along and the company raises 5 million at a 20 million pre-money. So they're effectively selling 20% of the company. And if you did nothing, you would be diluted to 0.8%, because the way that it works is that all of the existing shareholders, everyone is selling 20% of the company to the new investment round, so your 1% gets reduced to 0.8%. If you want to maintain your 1% holding, then you would actually invest 1% of the 5 million. So again, if you refer back to the formula, it's your ownership in the company times the new investment amount. That equals your pro rata amount. So in this case, that would be 50K. This has various implications for both up round and down round scenarios. So focusing on the up round for a second, and this I think is speaking to what Fred Wilson's point was, is that you want the opportunity as your winners are growing and are on an upward trajectory and are really showing that they're going to be able to generate a significant return, you want the right to be able to invest in those rounds. Because often what might happen is for companies that become deemed, very hot companies that are attractive to investors, so there will be a lot of new investors that are circling the deal and trying to invest in the company. And if you don't have a pro rata right, you could actually very easily get crowded out of that investment round and not be given any sort of allocation. It's not uncommon that a new lead investor would come and say, okay, you're trying to raise $5, $10, $15 million. Well, I want to take the whole thing. But what founders have to do, because they're legally bound, is they have to then tell the new investor, well, this is how much is actually being reserved for my preemptive investors, my earlier investors. So that's what is so important in up round scenarios. In down round scenarios, the preemptive right is important for a couple other reasons. Sometimes if a company is struggling but the investors around the table all still believe in the company's future, they might propose to do an internally led down round. And often the expectation, again, there's no obligation, but the expectation would be that each of the investors would pitch in their pro rata amount in order to provide the company with more runway so that it can hopefully then hit its milestones in order to be able to raise a subsequent up round. So again, this is not an obligation in that case to actually invest your pro rata, but it would be deemed sometimes as a best practice as far as how you're perceived by your co-investors. And that's why you should actually just know what that pro rata amount is, because it might be what is asked of you in a down round scenario. Lastly, in terms of the down round cases, it prevents any situation where someone is trying to lead an aggressive down round and if you didn't have a pro rata right, that could result in a situation where you're actually wiped out and your ownership disappears. But what your pro rata right guarantees you, it guarantees you the ability to participate and at the very least hold your equity constant. So we've now hopefully demonstrated that pro rata rights are extremely important. The issue is that individual angels rarely get this right. And actually, a couple weeks ago, Hunter Walk, who is the founding partner of a VC fund called Homebrew, actually tweeted that he's against passive angels getting pro rata rights. And he actually cautions entrepreneurs against giving them those rights. And his reason is that VCs are the ones who are continuing to add value over time, and that it doesn't make sense to crowd out money from VCs in order to allow your angels to continue to participate. So you can debate whether or not his argument makes sense, but what is clear is that institutional investors like OurCrowd and VCs are able to secure this important right, but often individual angels are not. Next term to discuss today is anti-dilution provisions. Anti-dilution is protection from dilution that results from when a company sells shares at a lower price than the price that you originally paid for your shares. So, I'm sorry, these slides were actually a little bit out of order. So we'll get to anti-dilution in a second. This slide is really meant to just explain the theory behind the pro rata. Okay, so how do you really think about your pro rata? The pie on the far left, that reflects 100% ownership of the company today. So you own 1% of the overall company. Now, let's say the company is selling 25%. I know that in the example that we said before, the company was selling 20%, but in this case, the company is selling 25% to the new investor, okay? So if you were to do nothing, okay, then in the post money, you'd own 0.75% instead of 1%. But let's say that you want your post money ownership to be 1%. Okay, so can anyone guess what that means you need to invest of the total new investment? If you do know the answer, then you can go ahead and submit it in the comments section. I would just like to, make sure that we're doing a good job explaining this. But Zach, we can go ahead and expose the answer. So what it means, as we demonstrated, that you need to invest 1% of the total new investment amount. And hopefully this illustration helps make it clear that the 1% of the 25%, that is you buying 0.25% of the company. Your original 1% is diluted to 0.75%, so at the end of the day, you're left with that same 1%. So now moving on to anti-dilution. Anti-dilution protection comes in a few different forms, okay? And these are all terms that you'll find in various term sheets. I'll tell you which ones are more common and which are less common. So the first type of anti-dilution protection is what's known as ratchet protection. And the example here, which of ratchets is probably the more common, is full ratchet. And what full ratchet anti-dilution means is that if the company issues shares at a lower price, your earlier price is effectively reduced to the price of the new shares. We're going to walk through mathematical examples of all of these, so don't worry. The other approach to anti-dilution is saying, no, full ratchet is asking too much. It's not that you should be adjusted completely to reflect the new lower price, but there should be some sort of weighted average calculation between the price that you paid and the price that the new investor is paying in order to give you some sort of downside protection and compensate you for the new round. And weighted average formulas break down into two camps. There's broad-based weighted average and there's narrow-based weighted average. What we've done here is we've given you the formula for broad-based and narrow-based weighted average, and we'll walk through some examples just to highlight the key and really only difference between broad-based and narrow-based is what you consider to be the number of shares that are currently outstanding of the company, okay? And the reason why that's important is because if you're weighting the old price, okay, by the number of shares that are outstanding at that old price, the larger the number of shares that you include in the shares that are currently outstanding, the more weight the old price is going to be given, okay? Which means that your revision to your price is actually going to be smaller, okay? So what narrow-based does, instead of including all of the shares of stock, including options and ESOP and convertible securities, narrow-based actually defines the number of shares that should be included in that calculation. And the most common type of narrow-based is where it's referring just to your class of preferred shares or to only the preferred shares in general and not to all of the shares. So let's walk through some examples. Okay, so in this scenario, investor A invests $2 million at an $8 million pre-money valuation for 20% ownership. Investor B then comes along and invests $5 million at $7.5 million pre for 40% ownership. So as you can notice, $7.5 million pre is lower than the $10 million post money that was after investor A invested. So here's what the cap table would look like if you had no anti-dilution. If you look at the first column, that shows that the founder has 8 million shares, the Series A investor has 2 million shares, and the split is 80-20. Now, if Series B comes along and buys 40%, that means that the founder and Series A are both going to be diluted by 40%. And that's how you go from the founder having 80% to 48%, and the Series A investor going from having 20% to 12%. And as you can tell in the price per share, the Series A investor had paid $1 per share, and the Series B is paying 75 cents a share. Now, the full ratchet, as we said, goes ahead and lowers your price effectively to match the price of the existing of the new investor. So we're starting at the same starting point here, where it's an 80-20 split between the founder and the Series A investor. And then the Series B investor comes along. Now, if you assume that the Series B investor pays, again, the 75 cents a share that we showed in the previous chart, then the Series A investor should also be only having to pay 75 cents a share. So now if you take the Series A investor's investment amount of $2 million, and instead of dividing it by $1 per share, divide it by 0.75 per share, you now see that the Series A investor effectively bought 2.67 million shares instead of just the 2 million shares, okay? What I want to show here is that there's this loop, and there's a very circular logic to these formulas. And if you're doing it in Excel, you need to be using iterative calculations. And if you'll notice in the second kind of column that the Series B investor has now actually been reduced from his target of 40% to 38.5%. And why was that the case? Because the Series A investor was given more shares, the Series B's overall ownership is now less than 40%. So what happens then in this circular way is that further drives down the Series B's purchase price in order to give the Series B more shares, which then further drives down the Series A's price in order to give the Series A more shares, and that eventually ends up settling at 69 cents a share, where the Series B owns 40% and the Series A owns 16%. So broad-based weighted average, as I said, this is a formula where you're weighting the existing shares at the old price, okay, plus the number of shares that the new investor would be getting if he was paying the old price, okay, and then you're dividing that by the existing shares plus the number of shares that the new investor is getting, okay? So it's this ratio that tries to come up with some sort of balanced average between the two share prices. In this case, here's how the numbers play out. We'll show a comparison across all the scenarios at the end. In the narrow-based weighted average, the way that I did the formula was I only included the Series A investors' shares as part of common shares outstanding, rather than also including the founder's common stock. And if you refer back to the formula and try to do this math at home, it will all work. And if you have any questions, please feel free to reach out. But now if you go ahead and you actually look at this cheat sheet, we lined up all of the different scenarios next to each other in order to show you the implications. So without any sort of anti-dilution protection, the founder and the Series A investor bear equal weight of the dilution, where they each end up getting reduced by 40%, and the Series B investor acquires 40%. But if you look at the examples of the full ratchet and the weighted average anti-dilution, so the Series A investor in each of those cases ends up with more than the 12%. Obviously, with full ratchet, it ends up with its highest amount, which is 16%. And with weighted average, as I explained, the narrow-based formula will end up resulting in greater ownership than broad-based. The next topic to discuss is vesting. Vesting is a schedule by which employees and management are able to actually earn their shares over time. So when you go ahead and you give an employee shares, you don't want to give them all to that employee on day one. Because if you give it to them on day one, then what's their incentive to continue to be working hard and being committed to the company? So typically there's a schedule which is a 4-year vesting period, and a term that is very common in term sheets is a cliff, and usually there's a 1-year cliff. And what that 1-year cliff means is that you actually earn no shares for the first year, but at the moment that year 1 ends, you actually then earn 25% of your shares, which was the amount that you would have earned over the course of that first year. And then over the remaining 3 years, you actually earn your shares on either a monthly, quarterly, or annual schedule. And that's how you earn your shares over time. And this is something that VCs think that is important, but it's also something that founders and management thinks is important in order to align everyone's interests and keep everyone incentivized. Because even among founders, if one founder ends up leaving the company and they have all of their shares, then that doesn't leave the founders who stick with the company in a good position. Board representation is a really important topic. Again, to quote Fred Wilson for a second time in today's presentation, he boils down the 3 terms that you must have in a venture investment to liquidation preference, pro rata, and the final one is a right to a board seat. Not everyone insists on the right to a board seat, but people who like to be active investors and really provide mentorship to the companies post-investment absolutely insist on board seats. So a typical board composition is made up of the founders, investors, and an industry expert. So one breakdown you might see, I'm negotiating a term sheet right now where the board composition will be 5 seats, 2 for the 2 founders, 2 for the investors that are coming in this round, and 1 for an outside industry expert. That also gives it a nice odd number in order to break any sort of ties. So what does the board of directors do? Has a lot of responsibilities, and just given the time constraints, I'm not going to go into any of them in too much detail. It approves budgets, it forms compensation committees in order to figure out how to compensate management. It makes sure that the financials are in order, and it really handles all of the corporate governance. And there are various activities within a company's articles that actually will stipulate that it requires board approval, and that board approval may be in addition to the approval of certain preferred holders or common holders, but the board definitely plays an important role, as do board voting rights. Evelyn Rubin, who actually is the partner who runs OurCrowd's portfolio management, she's our head of business development here. I actually wanted to get her opinion on what's so vital about a board member and what do we look for in a board member. So the way she puts it is that an OurCrowd director serves 2 key purposes. They function as the responsible adult in the room, ensuring that the companies adhere to reasonable business standards. The director's job is to protect the company, not just the particular party who may have appointed him or her, and to make sure that the best interests of the company are served. On a strategic level, directors provide guidance, mentorship, and direction to the management of the company. That's why we look for people with vast relevant industry expertise. That's something that we'll maybe talk about in a different webinar, that our model is to actually get outside industry experts to represent us on the boards, because those people understand the environment in which the company operates, and they really have the experience required to function as a sounding board to the CEO. So something that you might see in our deal terms is in certain cases we'll mention that we have the right to appoint a director. In other cases, we have the right to appoint an observer. The key difference is that a director actually is a voting member of the board, whereas an observer is not a voting member of the board. When we have observers, those observers are still invited to attend board sessions. They're still actively involved in the discussions. They're just not a voting member of the board. The next thing is information rights. Information rights are, after we invest, we want to make sure that we have a solid amount of communication with the companies. And by the way, it's important for founders also to know that in order to have happy investors, they should be communicating with them on a regular basis, because companies will need future funding down the road, and they also should be leveraging the strategic help of their investors. So the question, though, is how much information and communication is too much? What's the right amount? So in our deals, for example, we require financial reports to be provided to us on an annual and quarterly basis. And in addition to financial reporting, we also have inspection and visitation rights. So all of those fall under the umbrella of information rights. Veto rights. Veto rights are when a certain class of stock or certain investor within a class of shares has the right to veto certain activities. And that veto is normally phrased in the way of saying that their approval, that their vote is required in order for that action to take place. Veto rights, I would say, fall into two broad categories. Some are protective veto rights, and that's something like saying if we are the Series A preferred class, that we have the right to veto any issuance of new shares that directly hurt the rights that are associated with our class of shares, right? So that is what I would say falls under the protective. Control veto rights are more along the lines of trying to be able to necessitate that your approval is required for different exit scenarios, whether it's an IPO or an M&A, or for key hires and anything of that nature. If you would like to see a larger list of those types of veto rights, we'd be happy to provide that. The next one is right of first refusal and co-sell rights. What this is ensuring is that if common holders want to sell stock, then the investors have a right of first refusal on purchasing that stock, or they have the right to participate in the proposed sale. So if some large earlier shareholder thinks that they want to cash out and they think that there's liquidity for the stock, and if you're still bullish and you think that it's a buy, then you want to take first advantage of being able to buy up your share before that share goes to some sort of new outside investor. And that right of first refusal is actually distributed pro rata among all of the preferred shareholders. But if you don't want to go ahead and purchase more stock, then you actually also, in the co-sell piece of this, is that you have the right to participate according to your pro rata amount in that proposed sale. Bring along and drag along rights are really important, in particular when you have a cap table with a lot of different shareholders. So if there's a lot of small angels involved or earlier seed funds, you don't want it to ever be in a position where they're able to block a sale of the company. So what bring along and also known as drag along rights does is it sets a particular threshold and says that if for example 70% of the preferred holders vote for a transaction, then that forces the minority holders to have to sell as well. This is really important because sometimes the acquirer says that it's all or nothing. They want to be buying all of the stock, not inheriting any sort of existing shareholders. The last one that we'll touch on is registration rights. Registration rights, very high level. You very rarely see these actually being exercised. It's an investor's right to force a company to list shares publicly so the investor can sell them. There are three main types of registration rights, which are demand registration, piggyback rights, and S3 registrations. Again, in the interest of time, we won't go into those now, but demand registration, again, is if you initiate the registration of those shares. Piggyback is that if someone else, the company or another investor, actually demands the registration, you then don't have to use one of your demand registrations, but you could piggyback on the registration that's already taking place. So with exactly 0 minutes to go, let me just prep you for what we're going to discuss next week. Next week, we're going to discuss something which is really important because a large number of our deals and a lot of the deals that you see in the market today are not necessarily equity investments. And what we focused on the last 2 weeks are the structure of equity investments. But a lot of deals are done as convertible notes or a more recent structure known as safes. And next week, we will really dive into convertible notes and safes, understand why investors use them and like them, why companies use them and like them, and what are the key terms that are associated with those deal structures. If you have any questions, please feel free to email us, reach out. We'd love to know more topics to discuss, and we're always here for you. And with that, I'll turn it back over to Zach.
Thanks, David. That was another incredible presentation. We stuck to our timeline. That was 30 minutes. That was the second of a two-part series on equity investments. As David mentioned, next week, it'll be on Wednesday as well, will be about convertible notes. And that is that you definitely want to turn out for that one because that is a very common structure, particularly in early stage investing. Again, thanks to everybody who registered and showed up. I know our Australian and Asian investors as well have filed their grievances that the timing is not perfect for them. We're working on a solution, but we will have a video. We recorded this session, and we'll send out an email tomorrow with a link to the slides. A few of you asked if you could access the slides. We'll be happy to share those with you. Look for an email tomorrow. There'll also be a link in that email to register for next week's event, which will be lesson 3 of the 3-part series. Zack Miller here at OurCrowd signing out. Thank you, everyone, for joining us.